Ladies and gentlemen, Asian Guy here, and what I'm about to explain will change how you understand market crashes forever. We just witnessed something extraordinary in the silver market, a textbook flash crash that exposed the hidden mechanics of how modern markets actually work. But this wasn't just random volatility. This was a perfect storm of algorithmic trading, liquidity gaps, and psychological panic that created a masterclass in market dynamics. If you want to understand what really happened during the silver fever flash crash and why it reveals something crucial about every market you trade, you need to understand the anatomy of a flash crash. Because once you see how these events unfold, you'll never look at price movements the same way again. Let me start with what actually happened during those terrifying 90 seconds that wiped out billions in paper wealth and left traders staring at their screens in disbelief. At 2:47 p.m. Eastern Time, silver was trading at $118 per ounce. Normal volume, normal spreads, everything looked perfectly calm. Then, in exactly 87 seconds, silver dropped to $97 per ounce before snapping back to $112. That's a $21 swing, nearly 18% of the total value in less than 2 minutes. But here's what makes this fascinating from a market structure perspective. The crash happened simultaneously across multiple markets. COMEX futures, London spot markets, ETFs like SLV, even physical dealer pricing. Everything moved in perfect synchronization. That's not normal market behavior. That's algorithmic cascade failure. Let me explain what a flash crash really is, because most people completely misunderstand these events. A flash crash isn't just a big price drop. It's a specific type of market failure where automated trading systems create a feedback loop that amplifies selling pressure beyond what fundamentals would justify. Here's how it works. Modern markets are dominated by algorithmic trading systems, computers making thousands of decisions per second based on mathematical models. These algorithms are designed to be fast and efficient, but they have one critical weakness. They assume liquidity will always be available. When silver was at $118, the algorithms saw normal conditions. Buy orders, sell orders, tight spreads, everything looked stable. But underneath the surface, something dangerous was building, a liquidity gap. Liquidity is the market's ability to absorb large orders without dramatic price changes. In healthy markets, when someone wants to sell 10,000 ounces of silver, there are enough buyers at various price levels to absorb that selling without crashing the price. But when liquidity disappears, even small orders can move prices dramatically. The silver flash crash began when a large institutional seller, we don't know who, placed a market order for approximately 50,000 ounces during a low liquidity period. Market orders don't specify price, they just say, sell at whatever price you can get right now. Under normal conditions, 50,000 ounces wouldn't move silver markets significantly. But at 2:47 p.m. on a Tuesday afternoon, liquidity was thin. Many market makers had stepped away. The order book, the list of pending buy and sell orders, had gaps. When that 50,000 ounce sell order hit the market, it consumed all the buy orders at $118, then $117, then $116. The algorithms saw this rapid price decline and interpreted it as negative news, so they started selling too. This is where it gets terrifying. The algorithmic systems are programmed to follow trends and manage risk. When they see prices falling rapidly, they assume something fundamental has changed. They don't investigate why prices are falling. They just react. High-frequency trading algorithms immediately began placing sell orders. Risk management systems at major trading firms automatically liquidated long positions to prevent larger losses. Stop-loss orders, preset instructions to sell if prices drop below certain levels, were triggered automatically. Each wave of selling pushed prices lower, which triggered the next wave of algorithmic selling. In market structure terms, this is called a cascade failure, when one system failure triggers multiple other system failures in sequence. The most devastating part was the momentum algorithms. These systems are programmed to identify and follow price trends. When they detected the downward momentum in silver, they interpreted it as the beginning of a major bearish move. So they began aggressive short selling, adding even more downward pressure. Within 60 seconds, we had algorithmic selling, momentum selling, risk management selling, and stop-loss selling all happening simultaneously. The market became a one-way tsunami of sell orders, with virtually no buyers willing to step in front of the crash. But here's where market structure reveals something crucial. The crash stopped at exactly $97 per ounce. Not $96, not $98, exactly $97. Why? Because that's where the next major liquidity pool was located. Professional traders and market makers had placed large buy orders at $97, anticipating that any major silver sell-off would find support around the $100 psychological level. When prices hit $97, these pre-positioned buy orders absorbed the selling pressure and created a floor. The moment algorithmic systems detected buying interest at $97, they reversed course. The same momentum algorithms that had been selling aggressively suddenly switched to buying. Risk management systems that had liquidated positions began re-entering. The cascade failure reversed into a cascade recovery. In 30 seconds, silver bounced from $97 to $112, a $15 recovery that was almost as violent as the initial crash. Traders who had been liquidated at the bottom watched helplessly as prices recovered to near where they started, but their positions were already closed at massive losses. This is the brutal mathematics of flash crashes. They transfer wealth from unlucky timing to strategic positioning. The traders who were forced to sell during the crash lost billions. The traders who had buy orders ready at $97 made fortunes in minutes. But the silver flash crash reveals something even more important about modern market structure. The crash wasn't caused by new information about silver supply, demand, or economic conditions. It was caused by the interaction between market structure and algorithmic trading systems. Think about what this means. In a matter of seconds, the price discovery mechanism that's supposed to reflect the true value of silver completely broke down. The price moved 18% based not on fundamental changes, but on technical failures in market plumbing. This is why understanding market structure is more important than understanding fundamental analysis in today's markets. The fundamentals of silver didn't change in 87 seconds. Supply didn't change, demand didn't change, industrial usage didn't change, but the price moved $21 per ounce. The flash crash also exposed the myth of efficient markets. Economic theory suggests markets quickly incorporate all information into prices. But during the crash, silver simultaneously traded at $97, $105, and $118 across different platforms. Which price was correct? None of them. They were artifacts of broken market structure, not reflections of silver's actual value. The recovery pattern reveals modern markets are incredibly resilient in aggregate, but fragile in short timeframes. The market corrected the crash within minutes, but individual trader damage was permanent. This creates a two-tier system: sophisticated participants who understand market structure and position for these failures versus retail participants who get trapped by them. Sophisticated participants had limit orders at key technical levels. They were prepared for volatility, understanding flash crashes create opportunities. When silver hit $97, they were buyers. Retail participants had stop losses triggered during the crash, forced to sell at worst possible prices. They were liquidated by systems designed to protect them. Here's the crucial lesson. In modern algorithmic markets, traditional risk management tools can become risk creation tools. Stop losses that are supposed to limit losses can force you to sell at exactly the wrong time. Margin calls that are supposed to prevent larger losses can liquidate your positions right before prices recover. The silver flash crash also reveals the hidden role of liquidity providers in market stability. During normal trading, market makers and high-frequency trading firms provide continuous liquidity by constantly placing buy and sell orders. This liquidity is what allows large orders to be executed without dramatic price changes. But liquidity providers are not philanthropists. They're profit-maximizing businesses. When market conditions become dangerous, when volatility spikes or when they detect unusual order flow, they withdraw their liquidity to protect their capital. During the silver flash crash, liquidity providers withdrew simultaneously. The algorithms that normally provide continuous buying and selling interest shut down within seconds of detecting the initial selling pressure. This liquidity withdrawal amplified the price decline by removing the cushion that normally absorbs large orders. When prices reached $97 and began recovering, the same liquidity providers re-entered the market. They had successfully avoided losses during the crash and were now positioned to profit from the recovery. This is sophisticated risk management, but it makes markets more fragile for everyone else. The international dimension reveals more complexity. While COMEX crashed to $97, Asian physical silver markets remained near $115 to $120, creating massive arbitrage opportunities for traders with access to both markets. Physical dealers reported unprecedented demand during the crash. Customers who understood paper versus physical differences rushed to buy at temporarily depressed prices. But most retail investors were locked out by minimum orders, delivery delays, and limited access. The flash crash offers crucial lessons for modern market participation. Traditional buy and hold strategies become more important when markets face technical failures unrelated to fundamental value. Traders who survived without losses held physical silver or long-term positions that couldn't be automatically liquidated. They experienced volatility, but weren't forced to realize losses at artificial prices. The crash demonstrates why position sizing is critical. Even being right about long-term direction means nothing if excessive leverage forces you out during temporary technical failures. Market timing becomes nearly impossible when prices move 18% in 87 seconds based on technical rather than fundamental factors. This argues for dollar-cost averaging and systematic accumulation over perfect timing attempts. This is Asian Guy, and the silver flash crash wasn't just a 90-second market anomaly. It was a demonstration of how algorithmic trading, market structure, and liquidity dynamics create opportunities for some and disasters for others. Understanding these dynamics matters more than predicting price direction, because in modern markets, how you participate matters more than what you think will happen.